Most practice owners can tell you roughly how much money is sitting in their bank account each month, but then go ahead and ask them three simple questions. Question one, what did your practice actually make last month? Question two, what percentage of that revenue was real profit? And question three, what would your business be worth if someone wanted to buy it tomorrow? Unfortunately, most owners just don't know. And that's dangerous because your accountant's profit and loss often doesn't give you the numbers you actually need to run, improve, and eventually sell your practice. In this video, I'll show you how to lay down and create a simple down and dirty P&L. It's the same one I've used for years with our clients. It'll help you work out where your money's going, where your real profit is, whether you're overstaffed, whether your rent's too high, and importantly, whether or not you can start reducing your clinical hours without destroying your profit. I'll also share some important benchmarks for health business practices or health practices, including what a healthy rent to revenue and profit margin should look like. If you own a health practice, these are the numbers you should know every single month. Let's get into it. There's a problem with your accountant's financials and tax returns and using it as a business valuation tool. And you've got to think about it. The job of your accountant is really to reduce your tax. So they may include some dodgy expenses, help you pay less tax, but that also may inadvertently reduce the value of your business. The job is also to keep you out of court, which is a separate issue altogether. So in the buyer's eyes, sometimes a really good accountant can make your numbers look bad and make them not interested in buying your practice. Now, you may hear the terms add backs and adjusted EBITDA, earnings before interest, tax, depreciation, amortization. And that reflects, those words reflect the difference between your tax returns and your real profit and loss. So you've almost got two sets of numbers here when you really start analysing businesses. And as your accountant's job is to keep you out of court and to help reduce your tax, but their job's not really to give you a useful down and dirty P&L. Interesting enough, when I've done this presentation before, some of my colleagues are in this area don't like the term down and dirty P&L. They prefer the word normalized, which you might have heard the word normalized P&L. There's more problems with your accountant's version of your numbers. Sometimes owners wait too long to get their numbers, sometimes 12 months and longer. I'll talk to practice owners coming into our program now. So how's your last 12 months P&L? They say, well, I'm just waiting to get it from my accountant. How long have you been waiting for? 6 months? You just can't wait that long. So you've got to be careful about how long it takes you to get the numbers, because then it's way too long down the track. There's another problem. And by the way, this isn't a beat up on accountants. You've got to have an accountant. You've got to have a good accountant, but sometimes they're on a different page to what you're on regarding what you need from them. And there's another problem here. Most accountants advise owners to pay themselves or to pay their owner wage based on a tax reduction decision. Meaning the accountant will say, well, for the owner of the practice, pay yourself this wage or this dividend because that will give us the best tax minimization strategy. But the problem is most of that number doesn't really reflect the work the owner does in the practice, and especially their consulting work or their consulting hours. So I'll show you in a second how you put in owner consulting wages into your down and dirty P&L. Because remember, your accountant's version is not really a reflection of how many hours you do. The accountant might tell you to pay yourself $2,000 a week as a dividend, but really, and you might not do any hours in the clinic. Or you may be the same dividend and you do lots of hours in the clinic. So they're two different things. And our best clients in practiceology, they'll do their down and dirty, normalized P&L a few days after the end of each calendar month. And most of our best clients can't wait for that. They want to get their numbers quickly. They want to be rewarded and they want to have a look at the scoreboard. So there's part of the problems with the accountants. And I said, not to beat up an accountant, just you got to know what you're getting and what you need, the numbers you need to run your business. Now, why practice owners need a down and dirty monthly P&L? Why you've got to have a normalized down and dirty profit and loss? Well, firstly, you can work out from that what your business may be worth to a buyer or to yourself. As Michael Gerber said in the E-Myth, if you're not selling your business, then you're buying it. But is it worth the price you're paying for it? So you want to know your down and dirty P&L because you want to know if any offer you get is fair and reasonable or worth considering at all. This will help you determine the best time to sell. And you can also identify trends over time. You can see, is the business on the way up, on the way down? Is this seasonal? And it'll help you get out at the right time if you're looking at selling your practice. It also helps you track your progress and reward yourself. Knowing every month, well, last month I made 30 grand. Last month I made 20 grand. Whatever you made pre-tax profit, at least you've got a reflection on how you went and how you're going in the business. That tracks your progress. And this is the most important reason, I think, when I started, I'm going to show you in a second how we do it, but one of the most important reasons for the down and dirty P&L, I used it when I was coaching and still coaching clients now for them to work out when they can reduce their consulting hours. Because most practice owners it's like the dentist. They say if they're not drilling, they're not billing. Owners of health practices tend to fall back into the trap of just seeing more and more patients, and they think that helps their profitability. Now, it may do that, but there's a price to pay for that. And having a down and dirty P&L that has an allocation of owner consulting wage helps you work out where you should be in the consulting framework. Also helps you work out your sweet spot. Where are you maximally profitable? At what level of full-time equivalent staff? At what utilization rate in your practice? At what billings? How many days per week? So these things all contribute to finding your sweet spot of profitability. So that's some of the reasons why you should have it. How to calculate your down and dirty P&L, which is all your EBITDA, earnings before interest, tax, depreciation, amortization. Now, I'm not an accountant. I have no formal training, so don't send me to court or anything else for this advice. This is just what we've done over the years. I've run it actually past lots of accountants, and they're pretty happy with it. So it's just an idea of how to do it. Step number 1, calculate and add up your calendar monthly billings. So what did your practice management software system generate in invoices for the calendar month? Now, we're talking calendar month invoices, not money you invoiced and will receive later on down the track. So it's not how much cash you received, it's the billings you made. And that's accrual accounting versus cash accounting for the accountants out there. Now, I know there can be a problem with that. You could be invoicing and creating lots of invoices, but you send it to the insurer or the third-party payer, and they don't pay it for 3 months. So you've got this cash gap where you've invoiced here, but you haven't received the money for another 3 months. Can you see the problem with using a cash-based accountancy system for your P&L is those big invoices may not all get paid at the same time next year. So it's hard to compare this year to next year. So the insurance company might have just had a run of invoices and paid a stack all in one go. So at least if you're working this out based on your billings, what did you invoice for the calendar month? You're at least going to have an idea and something to compare to next year of the same month. So beware of cash gap. I know it's a cash issue, but do it on your billings. You then add in your stock sales, anything you sold in stock, and then also add in any other revenue. Do you rent a room out? Do you have a subcontractor coming in or a subtenant leasing space? So what are the other things that came in? So that gives you your calendar monthly billings for the calendar month. Step 2. So you've got your billings. Step 2, calculate your calendar monthly expenses. Now, this is where your accountant will get creative, and they might run your car through it. They might run the cleaner who cleans your house, but you run them through the business. Now, these are expenses that your accountant will get away with, but you don't put them in this normalized down and dirty P&L. So it's only real expenses, only the real expenses that you had to put out to make the money. It's not the conference in Vegas that you went to that was really a tax deduction. So just the down and dirty expenses, and our best clients just go to their bank statement every month. They go through it, then they go to their credit card, business credit card, and they just add it and put it into a spreadsheet, and they go from there. If you have a large expense, let's say you paid your insurance premium in one lump sum. Don't just put that in 1 month, just divide it by 12 and spread that over the 12 months of the calendar year. Okay, just so at least, because that insurance premium might not be due again the same month next year, or it might cross over. So you then can't compare this March to next March. So just spreading out the big ones, but you're trying to get an idea of what did I generate in revenue? What did I spend to do that? That's step 2. Step 3 is your staff wages, admin and therapists. Now, if you pay your staff monthly, this is easy. You can just punch that straight in, add extras, superannuation, sick leave, whatever else in there. But if you're paying them weekly or fortnightly, there'll obviously be times when the pay week crosses over months. So that's why it's hard to use your accountancy software to do this. You want to work out for the calendar month, what did your admin team cost you? So if you know the hourly rate for the admin person, how many hours did Brian work for this calendar month, multiply by their hourly rate, add their sick leave, superannuation, whatever else you got to add, which is probably around 20% these days, extras. And that's that person's wage for the calendar month. And the same for your therapists. So we're trying to work out a calendar month wages to go with our calendar month revenue. Step 4, and where some owners get stuck, is the calculating their owner consulting wage. Now, as I said, this isn't the wage that is in your accountancy software that your accountant told you to pay yourself. It's look in your diary for the calendar month, whatever that month is, how many hours did you spend treating patients? Multiply that number of hours by the replacement cost. What would it cost you per hour to get another therapist to do your consulting for you? 40, 50, 60 bucks an hour, whatever it is. Multiply that, and that's what goes in the owner consulting wage. It's a reflection of how many hours you did consulting in the practice. Now, some experts would say you should also, as an owner, do an extra allocation for your admin management work. How many management hours did I do? Multiply that by a replacement cost, put that in as well. I typically don't do that for my P&L. I just want the owner consulting wage, because then I work out whatever's left over is profit, and that's what I made for being the practice owner. Let me show you some slides and how this looks. It might then make a bit more sense when I show you this in a slide format. Now, just a tip for you, what I'm talking about today is part of my book. I wrote a book, How to Run a 1-Minute Practice. Simple read. It's not a big read. It's a simple read. Page 59 of the book, it talks about P&L analysis. There's a link under this video. You can download a PDF copy of the book. So it's just an easy read. Tell you a bit more about this, but that's what you can get. But here's what I'm talking about today. This is an example, like consult billing. So for each calendar month, what was your consult billing? Now, these are just arbitrary numbers, but the consult billing, stock billing, pool rental, anything else, and that just gives you your total calendar month billings. Down here becomes your admin wages, therapist wages, owner consulting wage. And this is all explained, as I said, in 1-minute practice, but you're splitting up your income and then your expenses. When you do your expenses, you'll have your expense columns, your accountant, your advertising, your postage, bookkeeping, whatever the expenses are, but only the down and dirty real expenses, not your car, not the cleaner that does home, not just the real things that you have in there. Now, when you do this right, this is what it looks like. This is an example of a P&L. This was actually done during COVID, and there was a month there where they forced this practice to shut. But you've got their monthly revenue or income across the top, admin wages across here per calendar month, therapist wages, owner consulting wages, which gives us a total wage bill. For this practice, the owner consulting wage for the whole year came in at $5,241. So we worked out for this owner, it would cost $60 an hour to replace them as the owner, and they do less than 2 consulting hours per week. So what do they walk away with? This owner walks away with $213K pre-tax profit, but they also get this $5,000 as well, because it didn't really take that. This is an arbitrary amount, so they walk away with $219 pre-tax. But you can see how we've split it up. There's an allocation for owner consulting. And what that does, reason why I did this initially, as I said, I can show owners over time, if their consulting hours drops, they can still maintain their profit, because sometimes they're scared to do that. Here's another example. Larger practice, 1.25 mil revenue, 25 grand owner consulting wage. We worked out it would about 50 bucks an hour to replace this owner. They did 500 hours over the course of the year, about 10 hours per week. Pre-tax profit, 500 grand. Nice clinic, juicy clinic, 500 grand plus the 25. This owner's making 525 out of 1.2, which is a very nice practice, by the way, a very nice margin. But look at this one. We've got a 947 gross, a 138K owner consulting wage. This guy just loves consulting. He did 1,725 hours consulting at 80 bucks an hour. So, sorry, $80 an hour. So 35 consulting hours a week over a 48-week year. Just loves consulting. But we have an allocation for how much consulting this owner does. His pre-tax profit, 382. But remember, he also has this. So he's actually made 382 plus 138K. So 520 total. But you can see how he's splitting up the numbers. Now, what this lets you do when you start analysing your P&L like this, now remember, this is not tax accounting. This isn't going to the tax office. This is not your accountant version. This is a separate, down and dirty, normalised P&L. From our experience, here's where some of these numbers should be as a percentage. Administration wage, we suggest it should be 10% or less of your gross revenue. Therapist wage, close to 40 if you can. It's getting up around 50 a bit more these days, but anywhere between 40 and 50. Owner consulting wage will vary. Oh, and by the way, we'll have some owners will come onto this and they'll say, you're on drugs, right? Our therapist wants 60% of gross to do any work. Well, you're in the wrong business. You can't be paying rent to revenues and other costs and be paying your staff 60 to 70% of gross. There's no margin left for you. But that's why owners are consulting all the time trying to make it up. So rent bill 50 to 60, total wages 50 to 60. Rent should be less than 10% of gross. Other expenses 10 to 10%, gives you a 20 to 30% profit margin. These days, probably closer to 20% than 30% for a margin, but you've got to allocate what's happening in this business as it goes along. And then when you look at it on a spreadsheet, you can see what's trending. So is my admin wage creeping up? We talk about staff creep. Admin wages increase over time. Someone's sick, but someone else fills in, then the other person comes back and there's more hours. So tracking that, your therapist wage, what's that doing? Owner consulting wage bill, rent to mortgage, rent mortgage as a percentage of gross, and your profit margin. And that's all inside 1 minute practice, which I think is a nice read for you and will help you get your head around this. All right, so that's a quick run around down and dirty P&Ls, problems with your accountant's versions, why you need a separate normalized down and dirty P&L to make good decisions about your practice. And I hope it gives you perspective on understanding dropping your consulting and how that you can still maintain a great profit, provided you know your numbers, and you've got to know those things. Too many owners just fly by the seat of their pants, wait for their accountant's numbers, and it doesn't work out for them. So I hope that gave you an idea on how to do it. If you want to download a free copy of my book, How to Run 1 Minute Practice, the P&L section's on page 59. You can get the download of the PDF. There's a link underneath this video. If you want to learn more about how to build a profitable health clinic that doesn't depend on you and is worth more to someone else, there's a link also to some free training under here. The training is titled Earn More, Work Less, the Practice Owner's Plan. The link's below. Check it out.